All right, everybody. Welcome YouTube. Welcome Trade Speakeasy to another edition of Options Strategies. This week we're going over a fun one. It's a strategy that teaches us a lot about volatility, which I think is the most obscure Greek at first. Like we all have an understanding of time, so theta kind of starts to make sense to us pretty quickly. We have an understanding of price because we see the P&L in our accounts, and we have a great understanding of that. And so delta makes sense to us pretty quickly. But volatility is a little bit strange to get our head around. And I think that studying this strategy can help to clarify what is going on when it comes to volatility. Hey, Greg. But before we can get into any of that, of course, we have to talk about risk. We have to trade responsibly. Past performance, whether actual or indicated by historical tests of strategies, is no guarantee of future performance or success. There's a possibility that you may sustain a loss equal to or greater than your entire investment, regardless of which asset class you trade. Therefore, you should not invest or risk money that you cannot afford to lose. Options trading is not suitable for all investors. That is always true no matter what. The nice thing about this strategy is at least it is a debit strategy, which means you're not going to lose more than you pay to enter it. So whenever you enter a debit strategy, what you're trying to do is see the price that you enter at expand. When you enter a credit strategy, you want to see the price that you enter at diminish. All right. So today we are talking about long straddles. Long straddle is to buy to open a long call and a long put at the money with the same expiration. So you pick a strike price at the money and you buy a call and a put at the same time. The market landscape for that, you expect a rise in volatility. We're going to talk about that today. And that rise in volatility should cause a significant price movement in the underlying, but you're not sure which way price is going to go. So you think, ooh, I think price is going to go somewhere, just not sure where it is yet. And these are the purposes. To take advantage of periods where an underlying is expected to make an outsized move where direction is unclear, and following that period, retrace back to the mean. And we can think of that as the 21 simple moving average. So the idea is one scenario would be, you know what, I think we're going to get a big move, but we're also going to get a retrace within a certain amount of time. So I can profit on one side and then I can profit on the other side. This strategy does not replace technical analysis. If there is a directional assumption, a directional strategy should be used to avoid capital mismanagement. And all that means is we should all be nerds in the charts. We should, like, I'm always looking at charts and practicing my charting and overanalyzing my so on and so forth. We shouldn't just be putting straddles on willy-nilly. We should have an idea of why we're doing it, because normally something about the underlying has to indicate to us that it's going to be effective. Otherwise, think about it. We're about to talk about buying a put and buying a call at the same time. We're talking about buying options. So you're buying two options at the same strike price. So you're paying essentially twice as much for that strike price as you would if you had a directional thesis. And that means that you have to get that underlying to move twice as large to pay for both of those debits. And if what I'm saying sounds a little muddy or a little bit murky, hopefully by the end of this presentation, it won't. All right. Purpose two is for advanced traders. We're trying to capture long volatility. We're going to have fun talking about that today. I'm excited to talk about being long volatility. And I've got a way to teach it up my sleeve that I'm excited about. But also capturing expanding vega on both long sides. And you think about it, if you have a long volatility thesis, what you're saying is, I think volatility is going to rise after I enter this trade. I think that Vega is going to go up. Well, if Vega goes up, it's going to go up on the call side and the put side. And so that's why this strategy can be beneficial for you. So you're trying to, the other idea is capturing intrinsic value on one side. So if you get the price to really, really move, well, now one of your sides of that straddle is going to be deep in the money, and it's going to have a lot of intrinsic value. Intrinsic value is related to how deep an option is in the money. And the other idea here is balancing the beta weighting of your portfolio. This is a hedging idea. So for anyone who doesn't know beta weighting yet, the idea of beta weight is you can go into your settings when you're looking at your positions is a nice way to do it. And you can add beta weight, and you can have it add beta weight versus SPY, beta weight versus SPX, beta weight versus NDX, beta weight versus the RUT. And what it's going to do is calculate an idea of how much your portfolio, meaning all of your open positions, how much your portfolio should be expected to rise or fall given a $1 move on any of those indices. And that can be really important and really helpful when trying to figure out portfolio management. I'm not going to get super into beta weighting now, but it is something that I want to talk about more later. And it's really worth investigating. I added in a couple risk profiles to this presentation because I just wanted to get everybody to think about, no matter what spread we enter, spreads are not greater than the sum of their legs. They're not greater than the sum of their components. And so every option spread that you enter is always going to either be you're buying a call, you're selling a call, you're buying a put, you're selling a put. They all act as their own individual options. The way you structure them together can help you to mitigate risk and can help you to express a thesis, but they're never going to be this magical thing. Like I do remember when I first learned about credit spreads, and I was like, oh, verticals are this cheat code. No, they're not. They're just two legs of in the option chain. That's all they are. But let's think about the straddle as a combination of a long call, and we know that a long call does have a capped loss. It's the debit that you pay to enter it, but it has exponential growth potential based on the movement of the underlying. We also have a long put. A long put has that same capped loss, has that same exponential growth. They both just have opposite thesis. When you put them together, you end up with a straddle. These names, whenever you see like an iron condor or a butterfly or whatever, they're describing what they think the risk profile looks like. So that's why it's called a straddle. This is a family show. I don't want to get too far into it, but the idea is, and if I can go backwards, capped loss. All right, we see the capped loss in both of these long options. Capped loss is going to be right down here where you enter at the money. And so what we want to see is price really give us an outsized move away from where we entered, because if we think once again, a long put has to move away from where you bought it to make money. It has to pay for its own debit. It has to get far enough away in a price action to pay for its own debit. Same thing with a long call. So they both have to pay for themselves. When you enter a straddle, the reason that it looks like this, and we see that it feels kind of deep in the money before you can actually like see a profit, is because you have to pay for the debit that you paid on the call side as well as the put side. You paid twice as much for that strike price as if you were only long one directional thesis. So you really, really need to think about getting a large move or being slick with volatility scalping. And we are going to talk about what that looks like. And so this slide is just really emphasizing, we primarily, when we enter a straddle, we want to see a really large move, but we're not exactly sure which way it's going to go. All right. The dynamics of entry: enter a call and put at the same time with the same expiration. Buy to open when volatility is relatively low. Before earnings windows, so 4 weeks before earnings season, volatility is low, you're paying for time. You know that as you get into earnings of a specific underlying, you should expect volatility to increase. We all see those crazy bounces in stocks when they have a crazy earnings result. And so this is a way to capture that. And I'm going to go through a couple of examples of what that might look like in a moment. When I enter when IV rank and historical volatility are unseasonably low, Vega will increase the price value on both sides of the long positions if entered when IV is low. And so what that means is, even though a long call and a long put have opposite price thesis, they have the same Vega thesis. They're both Vega positive options. So if Vega goes up while you're in either side of the option chain, if you're long either side of the option chain, you make money just because Vega went up. Now it still has to balance out with the other Greeks, but that is the fact. Vega is positive for you no matter what, if it's a call or a put. Theta is always negative if you're long. All right. So those two always are working opposite each other on the option chain. So a strategy for exit your position when you have reached the profit trigger. So an idea around this is, especially if you're entering it for the purpose of trying to scalp volatility, saying, you know what, I'm going to get in here. I don't know which way price is going to go. Price might not even go, but I know volatility is going to go up. Well, I'm going to enter a little, maybe 20% or 30% and try to get out with a higher volatility. And that will give me a nice profit. And then another way that's a little slicker is if price has made a big, strong move in one direction, but has potential to retrace to the EMAs or a support and resistance level, sell to close the successful long option. So what that would look like is price, let's pretend that price went to the moon after you entered and you still have a lot of time left on the contract. Well, your put is basically worthless at this point because it's so far out of the money. Your call is extremely inflated. So close your call, capture the profits of the call. If it rocketed straight up, chances are you're going to get a retrace. And on that retrace, now the put is going to fall closer to the money and you exit that for a profit as well. So that's one way to think about these. All right. Benefits is gamma is positive when at or near the money. Volatility increases the long options value. The big risks are theta decay because of opposing long position and delta loss on the failing side. So if price moves just a little bit, the direction that it moves towards is going to inflate. So if price goes up, your call is going to get stronger. It's going to show a profit. However, your put is going to show a loss. And if it doesn't move fast enough to compensate for that loss, theta is really going to eat away at the value of that put. And the price that you paid to enter it is just not going to be there anymore. So the sum of your position is going to be hurt. So you've got to be artful when you're entering and exiting these positions. So market dynamics to enter, we enter a call and put at the same time with the same expiration. Buy to open when volatility is low before earnings, 4 weeks. Oh, you know what? I'm sorry, I'm going so fast. I wanted to, I purposefully put this slide in twice because I wanted to show some examples but we're going to have to do those examples now. So I apologize. I'm a little embarrassed that I forgot my order of operations here, but I do want to emphasize this now that we're here. Buy to open when volatility is low. And we're going to talk about two examples. So we're going to look at Tesla's most recent earnings, and we're going to look at Apple's most recent earnings. And I'm going to go over two different ways that we could express a straddle thesis. The Tesla example is a little bit ridiculous, but it works. It's just like, I don't know how repeatable it is, and you'll see when we get to the chart. The Apple one is not as wildly rewarding, but when we get to it, I think that you'll see the argument that's like, ooh, this actually looks like a pretty low risk, very high probability of success, not a like knock your socks off reward, but a nice thing to add to your toolbook when you know that an underlying that you're following is going into earnings anyway. Okay. So with that, we're going to jump over to Thinkorswim. And if you notice, I've got Tesla's chart up, and I have three vertical timelines. All right. The central timeline is just letting us know when Tesla's last earnings report was. The most recent, not even most recent, we're not even there yet. The furthest to the right timeline is giving us sort of a expiration that we would want to target with this strategy. So in other words, notice I'm targeting an expiration that gives me about a month of time after earnings. And with the idea that, hey, I could be really slick and play a retrace. So if earnings gave me a bounce, I could fade it and play both sides of the option chain. Then the first timeline that you see is around when we would be entering. So we'd be entering a month before earnings with the idea and thesis to hold it all the way through earnings. And I'll show you on this chart, you can imagine that a straddle would be wildly successful just because when you enter here, we do get an outsized move even before earnings, because Tesla is it's not doing so well right now, guys. But it also isn't, you know, we shouldn't necessarily expect that every time we enter a straddle, we just get an outsized move. But I still am keeping the example because it's a really easy way to demonstrate a piece of software on Thinkorswim, which I think that a lot of traders use. But in other words, I think a lot of traders use Thinkorswim. I don't think as many of us necessarily know about this tool that I'm going to show. All right. So if I go over to the Analyze tab, normally when we use Analyze tab, we do it for risk profile. And if you notice, I haven't in any of my teachings taught with a risk profile. It's not because risk profiles are bad. Risk profiles are fine. But risk profiles become less and less necessary if you understand how the option chain itself works, because you can start to just calculate your risk based on what you see in the option chain. Does that mean that you shouldn't look at the risk profile? No, look at the risk profile, but it's not really my teaching style to use it. Instead, I'm going to draw everybody's attention over to this tab. This is the Think Back tab. And the cool thing about Think Back is it gives us volatility. When you go to practice on demand, you don't get volatility data while you're practicing there. It doesn't give it to you, or at least it doesn't give it to you consistently if it does. Here, we can research volatility for a given date. So if you notice right now, I have September 19th queued up and the underlying is Tesla. The reason I have September 19th queued up is because that is assuming we were shopping for options, trying to target Tesla's earnings call, and then trying to give us, once again, enough time to play their earnings. All right. Oops. So with that, this is actually giving us a look at the option chain and what it would look like at that time. So notice the most recent expiration that they have is September the 23rd. Pardon me. And so what we are going to do is look for an expiration after Tesla's October earnings call. So we're going to target November the 18th expiration. When we target that, we're going to open up the chain. We're going to buy the at the money straddle. And notice that we're looking at $30 plus $26 gives us a net debit of $56. So this is a large investment. But I want to see what this looks like now at Tesla's earnings. And so because they have earnings after market, I do want to look at this date, because volatility is going to be super high on the option chain just before earnings are released. So the next day after earnings, you won't necessarily have a volatility, but I do just sort of want to look at it to see, do we get a volatility boost for this expiration? Spoiler alert, we get a great one in Apple. I just want to look at this one now. So we're going to go back to the think back and we're going to plug in this date. All right. So notice the option chain has changed, but what's nice is they keep us open to this same tab. And you can all see what we were looking at was a $56 debit for the 306.67. Such a random strike price, but that's the price that we get, the 306.67 strike. And so now we have to scroll way down to find it. And now here it is. And you can see, oops, I don't want to actually order it, but you can see that on the put side, it's wildly successful. So this trade worked out really well, even before earnings was released. But also notice there's a little bit of a volatility boost. Volatility, if I remember correctly, was actually, I don't have to. Let's look at it. Let's see what volatility was at before earnings. Entered it at 63%. And then at earnings, or right before earnings, it's 83%. So you're getting a boost, and where that's going to help this trade is going to be on the failing side. This failing side is so far gone that you can see there's really nothing left on the call side comparatively. The call side is completely worthless, but we got enough of an outsized move that's enough. Now we can also look at this the next day with an even larger price, an even larger movement in price, put it on the 20th and see what that spread was trading for. Notice volatility has come down a little bit. It's actually still not too bad. And because we got a bigger move, now what was, I think, in somewhere in the 80s, now we're closer to 100. So you're closer to almost 100% profit on this trade. Not quite. I like the example because it shows that if you get an outsized move when you enter a straddle without a directional thesis, you can make money. I think that it's illustrative for that purpose. I don't think that it's as easily replicable. As always, we don't want to say like trading is never easy. You all know that I like to repeat that. But I want to show just sort of a different example with Apple and how to play around with this with Think Back. So we're actually not even going to enter back here. We're going to enter the week of, because while you play around with Think Back, you're going to see that Apple does something really fun on with volatility. So let's just look at their earnings is on the 27th. I always like to check to make sure it's after the market. So we know towards the end of the day is when volatility is going to be really high. It's going to ramp up all day, right up until the close, because it's going to spike just before the actual information is released. If we had earnings, if this was, released the morning, in the morning, then you would want to essentially structure this trade for the day before. All right. But we want to look at how the chain was trading just one day before on the 26th. We don't want to go this far out. Make sure that I'm doing this correct. Sorry. Yep. So the expiration I'm going to look at is the 28th. It must be a Friday, so it means that their earnings came on a Thursday. See that right now, volatility is pretty high. It's at 87%. Not a massive debit here. No, it's about $7 debit the day before. And then all I did, in case you missed it, went right up here and clicked us ahead by one day. Volatility on this same chain went from 87%. It more than doubled the next day. And so you can see now we have this, it's a $7 gain, or I'm sorry, your $7 spread is now trading for $6.30 plus $2. So $8.36. And you might be saying like, Jay, that's nowhere near as big of a gain as I was looking at Tesla. And I would have to agree with you. It's nowhere near as big of a gain as you were looking at Tesla. It's also, it's also a much more, I want to choose my words carefully. It's just a much more high probability risk to reward trade. Like we can assume that you're going to get a massive volatility boost leading right up to that earnings. And so sometimes, if we just want to compound easier wins, this can be the type of thing that can really start to boost a portfolio. And no one, who's to say that, that's, it may not be a huge number gain, but if you want to lay down a larger position because you're okay with the risk, then, who's to stop you from putting on multiple contracts if you're okay with that? I feel like this is a play that makes more sense than the Tesla play, just in my opinion, which is why I kind of like giving both. And then just for argument's sake, obviously we got helped because Apple did have a move, but let's pretend that Apple didn't move at all. So you can see we were paying for the at the money straddle, we were paying $7, right? We got a little bit of a move. So we got, $8.30 here. Well, look at where the at the money straddle is trading now. That's where this would be trading. And I'm going to bring this up now. Oops. What did I do? What is wrong with me? That's still, even if you got no movement from the underlying at all, just because of this volatility boost, you're still making $1 profit on that trade. And so I just want to encourage us as we're studying and trying to come up with strategies to trade. We all want to capture the trades that are exponential in growth. And we should be trying to make those trades with managed risk. But if we can add in some strategies like this, where we're getting some very reliable base hits, and you notice right here, price didn't have to move at all. All we were doing was saying, you know what? Before earnings, volatility on this underlying tends to spike. That's my thesis. And that's what I'm going for. And I made $1 that I didn't have the day before because I knew that. This is the way that we can start to play with options and come up with ways to compound wins for ourselves. And so with that, I would just like to encourage everybody to play around with ThinkBack. As you go into ThinkBack, look at some of your favorite underlyings. And I know earnings season just happened, but earnings season happens 4 times a year. So whatever you're studying, whatever stocks you've been trading, and we know that we don't necessarily want to have it's hard to have a directional thesis through earnings. It's hard to do that because if we're wrong, we're going to be really wrong and it's going to hit us in the mouth. But this type of a trade, I want to emphasize, you're not even doing it through the earnings. This is the close price of the 27th. And so you'd be holding this close to the close, and then close to the close, last 5 minutes of trading, that's where you'd be actually exiting your position. So you wouldn't even necessarily be trying to it'd be a way for you to, in other words, play earnings without actually even holding through earnings. And so I would just encourage people to look at that. One thing to also note with ThinkBack, it's giving us based on the price at the close. That's what it's giving us. And so any day that you plug in here, they're going to give you the price at the close, and they're going to give you the volatility that was happening at that time. So obviously, price is going to fluctuate throughout the day. Volatility is going to fluctuate throughout the day. But with ThinkBack, it's going to give you at least an idea and some parameters to play with. So with that, I'm actually going to pause my portion of the presentation, and I'm going to open it up for any comments, pushes, or questions.
Question.
Yes, Regina.
Now, I understand the taking advantage of the volatility like the day before in earnings. And like if it was after the 4 o'clock earnings, you're doing it the day before. Okay.
You're entering, so earnings with that Apple.
Yes.
You want to talk through the chart?
If we could, please.
Yeah, let's do it like that. Okay, so let's go back to the chart. Apple has earnings on the 27th. You'd be entering at a low volatility part of the day on the 26th. So, around noon, around, sometime like noon to the afternoon, not the last hour, because last hour volatility is going to come back up a little bit. Definitely not right at the beginning, not right at the open. Volatility is going to be really high relative to the day then. Instead, you're going to enter at a lower volatility time the day before. Then, because earnings, it has a different dynamic than most trading days, the open for Apple on that day, Apple's volatility should, historically should be lower than its volatility on the end of the day. So the end of the day is where you should really see that volatility ramp up. And that's when you sell to close your position and just capture all that volatility. Or, you leave some on, but the way that I was presenting the idea is you'd be closing it.
Okay. If, if there's like the earnings before market opens,
Okay.
then you would still be in the trade when the market opened, no matter what.
No, I wouldn't do it like that.
Okay.
What I would do is,
okay, go.
yeah. What I would do, first of all, find some underlyings that release at that time, which, to be honest with you, none of the ones that I looked at do that. But find some on think back, for thoroughness sake, to be sure. But the way that I would think about it is, let's pretend that this date is their earnings and it's before they open. Then I'm going to take this whole idea and I'm going to start it and end it a day before. So rather than entering on the 26th, I'm going to enter at a low volatility time on the 25th. Then I'm going to exit towards the end of the day on the 26th, because that volatility should still spike, because this is their last chance to get a position on before earnings are released. Once the earnings are released, then the uncertainty that's causing that volatility, that implied volatility to go crazy,
It'll be over.
Isn't there. Yeah, it's not there anymore.
Okay. I got it. Thank you. Now,
Absolutely.
doing them further, how far in advance? I mean, I know you can chart it, but I guess it's so hard. To me, I think of doing the straddles pretty much at the money.
Yes, straddle. Yeah, that's definitionally, it's gonna.
But how, if I can't do this like a month in advance, then this really would have to be in a couple of days of the volatility, I guess, expansion.
Yeah, I mean, sort of for the purpose of volatility scalping, you really want to be sort of get in and get out.
Okay.
If you're doing a longer version of it, like, let's just, pretend like you decided to get in here. Well, look at this big, long dip that you got. Wouldn't it make sense?
Yeah.
Especially, like, we all remember this day where we had this like big down move in the market and then it just exploded higher. Wouldn't it make sense at some point in this day, to close your put, right? And now, well, you're holding it, and now you have a choice to make before earnings, where you could say, like, okay, my call actually got back. All I've done is lost the theta that was on it. Maybe I close it now, because now I actually have a directional thesis for earnings, and I don't know if I want that. You could think about it that type of way. So if you're entering a straddle to hold for a longer period of time, you're actually sort of getting into it saying, like, we're going to move somewhere, and then we're going to fade that move. We're going to go in the opposite direction. So, like, even looking at this chart, and if you go back to Suzanne's original presentation, she does one on Netflix from a few years ago, where Netflix was in a corridor. And the idea was, I think this corridor is going to continue. So I sort of enter towards the center of the corridor. And when we get to an extreme, I close one end and wait to get to the other extreme. And then I close that end. So that would be a way to enter a longer one.
Okay, that's what I'm thinking about. Okay, that was very helpful. Thank you.
Absolutely.
Hey, Jake, I'm curious as to, and all of this obviously is with hindsight in mind, right? But if you were looking at the front end of this transaction, the 9, it looks like 9/27/22.
Yep.
Okay. And understanding that you don't have the luxury of what is ahead of you in terms of visibility. Your straddle price is, how would you approach that? I'm trying to understand, how would you approach that from that viewpoint? So
Yeah.
what strike would you be targeting, understanding that everything on the right of the 9/27, you don't have the luxury of seeing?
Yeah, absolutely. That's a great question. So your strike that you're getting in at, that's always going to be the at the money strike. That's the way that we're thinking about it. If we want to have a trade that is delta neutral, like
Yeah.
you're essentially saying, I'm betting on a big move one direction or another. So I'm neutral delta. I just needed to move big in one direction, right?
Got it.
Because if you go way out the money, then really that turns into kind of, it's still a straddle, but it functions more like a married put or a married call. Like it functions more like a directional thesis in one direction and a hedge in the other direction.
Yeah.
Which that's not really what this is. So if you're looking at this without the benefit of what comes ahead, the calculation that you need to make is that you think that you're going to get a larger move than the cost of your entrance. So another thing that Suzanne points to, and we can look at this also. So let's look at September 27th. Sorry, like for the life of me, this is my life. Trying to plug numbers in. We get this implied move next to the volatility percentage, and that's telling us the option chain's implied prediction for how far the underlying should move in between the date that you enter and expiration itself. So let's look back to the chart. And for the sake of argument, if we're trying to do this as well, let me ask you, do you want to try to do this as a earnings play, or do you want to do this more as like a corridor type play where, you just think that price is going to move up and down, so on and so forth?
Yeah, I mean, I was thinking of the same theme. If I did it as an earnings play, I'm assuming that ride down, and we'll validate it, I guess, here, but I'm assuming that ride down would have paid pretty well, right? Before earnings. I would have probably cashed out before, I'm guessing.
Yeah, well, let's find out. So I'm selecting the November 18th expiration because if we want to have room, if we're trying to play earnings, like an earnings move, then the November 18th expiration gives us time to play after earnings makes a move. Does that make sense?
Yeah.
Okay,
yeah.
Cool. So we're going to select the at the money straddle. It's about $18. Notice $18 is less than the implied move, which is 19. So we're already in a reasonable place. Doesn't mean that it's going to work, but we're in a reasonable place.
Okay.
Now, and this is where it's a little tough, because the first thing that would have been nice is to look at the price of it when it was way down here, right?
Yeah.
And, we can't look at that because it's going to give us the close. So for a happy medium, let's just say, you notice how all these candles bodies are respecting like sort of the 138 line.
Yeah.
So let's just pretend like on this day, price opened way down here. We weren't really sure what we were going to do, but once we got back up to this, and this is actually really a reasonable way to think about it. Once price came all the way up here, we were like, I don't think we're getting much more of a drop for this part of the leg. So maybe now is the time to consider closing the put side. So let's just, the closest close that we get to that is here on the 12th. So let's plug that in. Remember, we paid 18 to get in, and it was the 150. I wasn't, just so you know, Greg, I was not saying that for you. I know you know. I had to say that for me. So here what you can see is you'd have to do some finagling at this point. So it'd be some management. You've got almost your whole debit back on the put side, but not quite. So you can see you're looking at a little bit of a loss, not much of one. Yeah. Right. But let's just sort of paper trade this scenario. You captured 1445.
So if you close that out and waited, okay.
Yeah, close it out and wait. And let's see if this can recover for us. So now we have this big day up, and let's just see what does it look like on the 25th.
Yeah. Okay, so 7.5.
Yep. So you made, to me, when I think about and everybody's different.
You made $3 basically.
Yeah, you make $3 for a lot of thinking. Like, you know, like a lot of thinking and a lot of all the other emotions that come with those thoughts. That's a hard, I'll just be honest, for me personally, that's a harder trade for me to conceptualize. I like the more the idea of Vega scalping, but also, and you know, we got to bring up my favorite chart. Look at just the last, look at all the gaps we've gotten. That's another thing that I would encourage people to play around with, is how many times does entering closer to, and this is something that Suzanne talks about as well, is another way to imply these straddles is to say, you know what, I wouldn't necessarily enter closer to noon, but I would maybe enter at around the last hour, but closer to the start of the last hour. So like around 3 o'clock Eastern, you know, definitely before 3:30 Eastern, when we know volatility is going to get higher. Well, now if I get a gap the next day, I mean, think about if we did it yesterday, because we got this huge gap down.
Yeah.
Now, also just think about the scenario when the market opens. We all know that that's a great time to sell iron condors because we're capturing so much implied volatility. Well, now you've got a nice delta on your put side. You can close that, close it right away, and then you can kind of just decide like, oh, are we gonna keep on falling? Well, if we're gonna keep on falling, I should close the call. But if you know, if we want to fade, if the market wants to fade the gap, if it wants to come back up, then I can hold that call. And so that's another way to think about playing these. I just personally, I do not think the days of gapping is over. I don't. I think that we've gotten so many, I think that we really, you know, and the reason why I think that is, we all know that the market is so sensitive to economic data that's being released. Like it's super, super sensitive. because everyone is looking for either a reason that they think, you know, the Fed is going to ease off, or everyone is scared for a reason that the Fed is going to keep on hiking.
Mm.
And so the market just continues to key off of that before it even opens. So this is really just another way to think about the straddle. I purposefully chose the less complicated example for teaching purposes, because I really do think that clean volatility scalp is a high probability one to pull off. But I would say that the day before idea of saying, like, you know what, I'm gonna enter this trade the hours before, and then I'm gonna close it. That's something to definitely play around with in sim, and to definitely play around with in on demand. And it's always, the principles are the same. You have to figure out if you're getting a big enough move versus the debit that you're paying to get into it.
Yeah, I mean, I think if I looked at your numbers correct, you were in at $6 and some change and got out at $8,
Right.
8-ish. That's a 20-something% move,
Yep.
which is respectable,
Right. Right.
especially if you're doing multiple contracts, right?
Right. You know, according to any trader's risk parameter, but also it's just something to think about in terms of, is it something that I can incorporate into my trading plan that is repeatable?
Hmm.
You know?
Yeah. Appreciate it, Jake.
My pleasure. Thank you for the questions and conversation.
And I know you're Jay, but you're listed as Suzanne, by the way.
I was joking around about that just before I opened the room, and I was like, today I'm gonna change my name. And I was like, I don't know how. I forgot how. And so no, I'm, surprise. I'm not Suzanne. Want to give a little bit of a pause to see if we have anything coming through in YouTube. To everybody in YouTube, by all means, if you got questions, please drop them in the chat.
Nothing on YouTube so far, Jay, but it's really been interesting, really fascinating.
Thank you. I'm just gonna bring up SPY one more time. This is just sort of a question for the community. I'm a little frustrated because I had a really cool sim defense of a credit spread gone wrong. I entered in sim. I would have taken this live, full disclosure. I entered a call credit spread, like we've talked about a couple weeks ago, on this day in sim. And the reason I did it in sim is because I was concerned about the wait.
You're not sharing yet, Jay.
I'm not sharing. Good, because I think I'm even looking at the wrong candle. I am. All right, cool. I'm still not sharing. This is the first time I did it tonight, though, right?
No, everything else been great.
Where was it? I'll be able to find it better on the hourly chart because I know it was a Tuesday. Sorry, everybody. This is clearly a riveting presentation right now. Yeah, I think it was right here. But anyway, I entered I'm not even going to share because I'll just sort of get to the point. So sorry for all of that. I entered a credit spread in sim that went poorly, and I was able to defend it with some, basically, like we talked about in terms of playing defense, I sold, put credit under it as price was moving bullishly. And I also bought a call, but I bought a call spread. So I bought a call to sort of to neutralize my deltas on the call side that were getting attacked. And then I sold a call above it to bring down the price of that. And then when price backed off on this Tuesday, I sort of took off the bullish sides and let the trade recover. And the whole time doing it, I thought I'd be able to access the history easily in my sim, but I haven't been able to do that. So I can show sort of the I will answer that right now. Big question is, if anybody in the community knows how to like look at sim history, please send me a message so I can kind of walk through sort of everything that I did to defend that. I have been a lot better as a live trader taking notes. Like if this was a live trade, I would have it all journaled, but I didn't do that for sim. So lesson learned. With this strategy, as you suppose to close the legs separately. So it depends. If you're trying to do a volatility scalp, then you just want to close the whole structure. And so you can just sell to close the structure. If you are trying to capitalize on a price move and then a retrace, then you do want to close those legs separately. Because if price goes up, then you want to close that call while it's deep in the money and capture those profits. Then as price retraces back down, that's when you want to close your put side. And so opposite, if price falls, then you want to close your put side first, then price comes back up. And the reason why is once price makes a really big move, you lock in your profits on the successful side. And now you have a minimal risk to reward for the piece of the straddle that's left over, because the piece of the straddle that's left over is worth significantly less now that that big move occurred. So now if you have a directional thesis that says, you know what, we got this move, now we should start to see a retrace, which is common in price, then this can recover a little bit for me. So thank you for that question. I hope that cleared it up. All right. Everybody, you've been great. I had a lot of fun talking straddles with everybody. If there's no more questions, I am going to go ahead and wrap it up. But once again, thanks to everybody. Vicky, thank you for keeping us clean on YouTube. Regina and Greg, as always, thank you very much for the insightful questions. YouTube participants, thank you all for your questions. As always, anything extra, reach out in the main group in Telegram. You can also reach out to me. I always love to talk options, all of the above. So everybody, have a great night. And we will not be meeting next week. I'll be with family. I'm sure that a lot of you will be with family. But we will be back on the following Thursday. All right. Happy Thanksgiving, everybody.